The month of April was very weak, which historically tends to lead into a little bit stronger month of May. We'll see if that works out. May tends to be one of the weaker months of the year in terms of performance, particularly during presidential election years. Let's talk about it a little bit before the bell because the correction does continue. So we talked about that we came off this support at the 100-day moving average and we rallied up into the 50 and we failed there. So that was that first test of resistance that we had discussed. And yesterday, because of the economic news and because of other stuff that was going on, we did fail at that point. Market sold off about 1% yesterday. So that's not really dramatically surprising that we failed at the first test of overhead resistance. Now, the important thing here will be that we hold support here at that 100-day moving average. So that's going to be first level of critical support. We tested it here back earlier in the month. So again, now the market needs to hold that support and keep that support intact, form a double bottom here, and then make a move higher into May. Now, one thing is that the month of April was very weak, which tends to, historically tends to lead into a little bit stronger month of May. We'll see if that works out. May tends to be one of the weaker months of the year in terms of performance, particularly during presidential election years. So again, there is some potential here that this correction could continue to drag out. But here's the risk. We still remain fairly deviated from this longer-term 200-day moving average, which is sitting down right around 4,700 right now. So again, there's a fairly decent decline, about another 5% to get to that 4,700. So that would encompass peak to trough, that 10% potential decline that we've talked about, so far this year. So we said, back in February that we could have a 5 to 10% correction because we were so deviated from that 200-day moving average. So we are still within the context of having this 10% correction. Again, completely normal, right? I can't stress you this enough. Happened last year as well. We had a 10% correction last year. It's unusual to have two 10% corrections back to back. It can happen. It's not completely out of the realm of possibility, but it is unusual. But if we do have a 10% correction this year, that would be completely normal. I still think it's a bit early to have that 10% correction. I would expect that to occur really kind of September, October heading into the election. But again, this is certainly possible. So again, the key point here is that we hold that 100-day moving average at 4,700. A failure there is going to suggest a bit deeper decline. But again, this has been fairly orderly, low volume, low volatility. So again, there's not a lot of panic going on in the markets right now, but just something worth kind of paying attention to. And again, the Fed today will be a big determinant of what happens next. And we'll talk about that with Michael Leibowitz tomorrow. That's what you need to know before the bell this morning.